Wonderful. Well, Sue, first of all, thanks so much for getting this put together for us. We really do appreciate all you do for us. So thank you. So my name is Tom Sherman, and I'm with Benchmark Mortgage. And I'm super excited to have my good friend Sam Thornal on this call. Sam has been with Ameriprise Financial Services for over 21 years as the CEO of Encircle Wealth Advisors. We've had a tremendously great relationship, not just friendship, but also just a business relationship. And I've really loved more than anything how he's able to look ahead, educate, and coach and consult his clients. And for those of you on the call, you know that our focus at Benchmark is also to coach and consult. So knowing someone in the financial services arena that does that as well is a big deal. So super excited to have Sam on here today. And we're going to be talking about a topic that maybe you've heard about in the news, a topic called inflation. And if you haven't heard about it, you've probably felt it at the gas pump, at the grocery line. If you're trying to buy a car, if you try to build a house, if you try to build a swimming pool, you get the point. You felt inflation. So, Sam, first of all, welcome. Thanks so much for being here. And if you don't mind, tell us a little bit more about yourself.
No, I appreciate it. It's always fun to hang out with you and Sue. As you said, been a financial advisor now coming up on 21 years. I love what I do because I get to work with people from where they're at today financially to where they want to be in the future. I have my family here in McKinney. We've been here, oh my gosh, almost 10 years now. Avid golfer and love traveling. And so I get to connect with my clients on how their life here in DFW has grown over the years and changed, and just enjoy what I do. And thanks again for having me.
Absolutely, man. So let's kind of start out with some definitions if we can. And as you know, my degree's in economics, and the conversation around what is inflation was one of those things we studied in economics, and nobody seemed to be able to actually explain it. So dumb it down for us. What is inflation?
Gotcha. Pretty easy. Inflation is why a dozen eggs cost more today than they did a year ago or 50 years ago. Basically, it's the rise in cost of goods and services that erodes your purchasing power. As the cost goes up of goods, you're able to purchase less. You'll hear a lot of it on the news. The number that I tell my clients to always listen for is the CPI, the Consumer Price Index number. And they usually will announce that first week of each month, and they'll tell you how it was for the previous month. And I want clients to always understand that measurement of inflation is sometimes tough for people to grasp. They think that inflation goes up, and that the only way for inflation to go down is if prices come back down, and that's definitely not the case. And so the way I tell it to my clients is inflation is almost a measurement of acceleration. If bread goes from $2.50 to $3.50, that's a very large percentage jump. If it goes from $3.50 to $3.45, they'll say inflation came down because it's not moving at such a fast rate. And that's where people get a lot of confusion. At one point in time last year, we were moving at a 9%, over a 9% inflation rate. That was a measurement over a year period of time. And now it's dropped down closer to that 3% level. It does not mean that cost of goods go down. Trust me, my clients will go, well, Sam, inflation hasn't come down. The grocery store is still very expensive. And so I talk through that with them so they understand when they're talking about that number. We're just trying to get inflation to slow its pace over time. And so
that's a really good point, Sam. So the idea of saying, hey, we're trying to get inflation down, which that's obviously been the buzzword for the last 18 months, that doesn't mean we're going back to pre-2021 prices. That just means the appreciation is going to slow down.
Yes, exactly. And you're hoping that wage inflation is happening at a greater rate so you don't lose that purchasing power over time. So we know we've seen wages go up. The problem, you can run into these periods of time where inflation of goods and services are going up faster than inflation. So this is here in the last 2 years, we have actually seen wages keep up with pace. But once again, that's a very generic statement. Of course, I can talk to one person in one industry where they haven't experienced that, their wages haven't gone up. But overall, the measurement is it's kept up. But that isn't always the case over time. But one thing I also want to talk about is, what are they purchasing? Whenever they define this consumer price index, they basically mimic buying a bunch of different baskets of goods, foods, housing, clothing, healthcare. And so when you get that number on that monthly basis of how things have gone up and down, you want to be careful, because you almost got to dive into the actual underneath numbers to go, how has housing specifically increased from one month to the next or over the last year? Certain items can come down dramatically while others go up. So that number isn't everything. It's not, everyone's not going to feel it the same way. I think that's probably one of the biggest things that I talk to my clients about, is how people feel inflation personally. And some people may not, if they don't go out to eat, they may not see the prices of restaurants going up. Gas, if they don't drive that much, like me, I'm spoiled and don't drive around that much and only fill up my tank every 2 months or so, I may not feel that at the gas tank. But the one thing I do see that people feel is definitely at the grocery store. I think that's probably been the one common denominator across all clients here over the last 2 years, is that consistent pain whenever they go to the grocery store. But once you start to understand inflation, the acceleration, and how they measure it, you don't get too emotional about 1 month to the next. You can see things fall off and come on. One of the best examples is probably housing, where you'll see rental rates will go up. Well, those rental rates will stay high because people are in leases. So it takes a while for that housing inflation number to start to come down. Just like mortgages, as you know, Tom, the mortgage rates will go up. And so people are paying that higher mortgage. It takes a while to see that housing costs start to come down over time.
So Sam, would it suffice it to say that inflation is simply prices going up? Is that a simple thing to say?
Simple. Yeah. But once again, prices going up, but inflation is not, or deflation is a different topic we'll talk about, I know, in here, but it doesn't mean prices are going to go back. If things level out and the prices aren't going up as much, that's where we're happy with inflation at that point.
Okay, so, and not to chase a rabbit, but one of the things that I had always understood just myself getting into out of school was that inflation had more to do with the value of a currency, not the cost of goods sold. So kind of explain that difference, if you don't mind.
So let's think more. That's the effect of the dollar against foreign currency, right? And so when we think about traveling over to Europe and we exchange our dollars for those euros out there, that global currency exchange rates can go up and down over time, where inflation, think more locally. You don't experience that currency exchange issue if you stay in the US. But if you travel overseas, you're going to experience that currency, the dollar strength against another currency out there. It's been interesting because we've seen the dollar actually be very strong over the last several years. And it's actually been a pretty easy time to travel overseas right now. It's amazing how many clients have taken advantage of that. And they're like, oh, wow, it's actually cheaper to travel right now. And I actually talked them through the idea of the currency exchange rate. Now, remember, if you're in the country and you spend your money in that country, you may not feel that exchange rate. But if you're a company that sells goods overseas, well, now that exchange rate, whenever that money comes back to you, it's going to produce less income coming back. So that's something that impacts large companies, that where inflation's local, think currency can affect corporations when they do business in the country or outside the country.
I love that. So obviously, inflation is nothing new. We've experienced that in our country before. So what's happened in the last couple of years? And if you don't mind, just kind of, I would say let's look at a scope of view from 2008 till today. What has happened? everybody talks about inflation going up and home values going up and prices going up, but what has occurred? What's gone on?
Well, what's interesting, if you take after 2008, that financial crisis and past, inflation has actually been pretty consistent over that period of time. It's been supercharged over the last two to 3 years, based on, of course, COVID. What happened was this unprecedented amount of government stimulus that has kicked in that we hadn't been having up to this period of time. So it created an imbalance. So the government, good or bad, I'm not here to judge on that. They stimulated the economy because they were really worried about, with people staying home, what that was going to mean to the overall economy. So they stimulate with PPP loans, with stimulus checks to the average person that's out there. And that means more people have money in the bank, more money in their pocketbook to go and spend. But the exact same time, what did we run into? This was a phrase I know, Tom, we talked about that I was just done talking about, with supply chain. Supply chain. We all experienced it, from Best Buy to anything we bought. All people had to do is, oh, supply chain, it's supply chain. And we got frustrated, but it really was one of the biggest impacts, or the second part of the double whammy. Give us a bunch of money, but then actually have the amount of goods drop, the supply drop. Well, now you have people that are with money competing for less items, availability. Well, that's inflation 101 right there, is when you have an imbalance in the system. And so that's, of course, COVID, we had this period of time also, the supply chain for people not going to work, manufacturers and people like that, where one part of the world was able to still work from home, like we're doing right now on video conference. So we got behind on that production, and it's taken all the way up to the last couple months, where economists will tell us we're pretty close to being good in balance of supply and demand. Now, there's always going to be certain areas where that's not true. We know on housing that's true, and I know we'll talk about that. Cars are another example out there right now, where they got behind, so we had less car supply, so people were competing for supply. I know used cars went crazy because we didn't have new cars, so then all of a sudden you could trade in your used car below 3% over that period of time. In fact, in some areas we're at 1%, because very consistent, but it's that offset, that extra money supply that came in at the exact same time that supply dropped, and it created just a perfect storm.
So obvious question. It seems logical, like when you explain that, it seems like that would be the obvious situation that was created. So was it just missed? Did they just miss that situation, or how did that happen?
I don't want to be armchair quarterback. Hindsight's always beautiful. I think it was we've never had this type of global panic in recent, life. And so they figured they'd rather miss on the high side of giving too much versus too little, and cause some type of depression type of event that's out there. I think over time that the historians will be the best people to be able to come back and look at this and go, wow, if they would have only done this, then it wouldn't have created this period of time. But it did create what they wanted it to do. I mean, people had money and they've been spending, but there's always that balance, coming back to that balance. And that's what we're at right now, and may lead to an overbalance the other way that I know we'll talk about here in a little bit.
Yeah, so that kind of leads me to another question, because inflation, whenever you hear the word inflation, people, if you watch the news, they hear prices going up, interest rates going up, mortgage payments going up. It's never painted as a positive thing. So, is inflation like, the big bad scary monster under the bed, or is it really not that bad? We just need to understand it.
No, inflation definitely not a big bad thing always. It's all about being a healthy rate. And what the Fed here in the United States they're trying to hit a target around 2% inflation. That's kind of their self-imposed mandate of where they want things to increase over a certain period of time. And the reason they have that goal of 2% is you don't want inflation to become unanchored one way or the other, where it runs too high and too rampant, or we can get that deflation that I mentioned a little bit ago, where prices start to come down too fast. Now you can have a downward spiral. Everyone starts lowering their house prices to get that purchase made. And you can think about the gas wars in the 70s that were out there of lowering gas prices. We would love a gas war right now. I know the average person would, but no, we want inflation to have a target, and that's what the Fed's doing. And they're trying to create this perfect Goldilocks, not too much, not too little type of situation out there. But when you get these periods of time where something causes a big disruption to the supply and demand, you're going to get this high inflation. So if we can get the people back to spending less, right, as the Fed raises rates to slow down consumption. So if it's okay, I'd like to talk about that one, is what the Fed's actually trying to do to calm this down.
Yeah.
If people have a bunch of money because the economy has been stimulated, and we have the supply disruption, but supplies come back in balance, people can still have some money. And so if inflation's still running high, we're going to want to try to get people to spend a little bit less. So how do you do that? You raise interest rates. You're trying to make money more expensive. And what I mean by that is, if I make interest rates on the credit card a little bit more expensive, maybe somebody will hold back a little bit on buying that new item TV for their house. If I make it a little bit more expensive, maybe as many people won't be buying vehicles at this period of time. So if you can get people to slow down on their consumption rate, on what they're spending, then we can get back to that equilibrium of supply and demand. But you're talking about the entire U.S. economy. And so we usually don't get this perfect situation where it gets perfectly in balance. Sometimes we can overshoot. Sometimes it takes longer to get it back in balance. So where we hate the increasing interest rates, I want people to understand what it means if they didn't attack this. Imagine if they didn't raise rates and we kept spending at that same process, inflation could run rapid on the high side. And so that's what this Fed has told us over the last year and a half, as they've been raising interest rates quickly, is they do not want to create the mistake that they've done in the late 70s and 80s, where they raised interest rates, they slowed inflation down, so they started cutting interest rates, and inflation took off again. This Fed has said, we're not going to do that. We're going to keep those interest rates higher for longer to make sure we get inflation down to that 2% target. So I know we've been talking about this, Tom, personally, and the impacts on our clients, but that higher interest rate for longer just means people need to buckle up and understand that this isn't going to be solved probably in the next 1 to 3 months. It's going to take a little bit more time, is what the Fed's telling us.
Right.
Yes, that's a really great point, Sam. And it sounds to me, and I'd love you to kind of speak to this, but it's sounding like the only person who has control over inflation and deflation is the Fed. But is that really true, or are there other factors that impact it?
I'm going to say they're one of the biggest. Government spending, right? I can put that on there. The Fed has these levers that they can pull in terms of raising interest rates. They can also do something else where they try to take money out of the economy. So what I mean by that is, if I sell a bond, then somebody's buying that bond. So now I have their money. So they don't have that money to spend it. So the government can do these types of mechanisms here where they can raise interest rates and get money out of the economy, slow the money supply or remove the money supply. But then government overspending, I'm going to say, is probably what the biggest factor has been over the last 2 years, of that, both at the same time. Fed cut cut rates and lowered them, and we stimulated at the same time. So I'm going to say the average person, can they have an impact? If somebody wants to boycott buying a car, absolutely feel free. Are they going to have a huge impact? Personally, no. It takes these big mechanisms that the government and the Fed that are going to make the biggest changes. Now, if consumer consumption pulls back, then absolutely, we just have to do it as a big mechanism. And right now, we've been talking about how resilient the consumer has been. And that's code word for they've kept spending, that they haven't pulled back. They've been resilient because they're spending that stimulus money that was given to them. We also have a job supply issue right now. We had a lot of retirement occur over the last 2 years. The boomer generation decided, hey, it was time, and they started retiring. So then all of a sudden you had people out of the workforce, less people working. So then what did businesses have to do? They had to turn around and start hiring people. And this is why that unemployment rate dropped so quickly. And so now there was inflation on the wage side of the equation. I was paying people more because I lost this workforce started to leave. So wages were coming up. And so businesses have a big impact as well. If you're asking other places that can have an impact on inflation, businesses, if I'm hiring a lot of people and I'm paying them high wages, and we saw that. I mean, we saw a lot of people, they count the number of quits per month, the people that quit jobs and switch jobs out there, and it got to all-time highs. The number of jobs available in the market hit all-time highs. I think 10 million, maybe 11 million at one point in time. So people felt confident that they could move and they could demand a salary. That started to taper off a little bit, but the unemployment rate is still very low. So we have this tight labor market. So that's also impacting inflation. If people have jobs, they have money. If they have money, they spend. And thus the cycle of inflation will continue.
And I guess if wages are increasing at a rate faster than inflation, people might be unhappy that prices are up, but it's probably not going to change their lifestyle or decisions because they're still making enough to pay for what they're buying.
Right. And all that's on perspective of what level of income that you make, of course, is like someone that makes 50,000 and sees a 10% increase is very different from 150, right? That sees that 10%. So I'm always quick to tell people, it's like, hey, you may not feel it, but maybe that other worker down the road is going to feel it more. But yeah, ultimately, what you'll see in any of these cycles of a tight labor market is wages will go up for a little bit. But then they'll always start to settle down. And then the question is, does inflation settle down at the same pace? And we tend to never get it perfect.
So that brings me to another question. What things, for those of us who are in the industry, whether we're investors or lenders or real estate agents, whatever, what things should we be watching to say, hey, we're starting to see inflation get under control, rather than just reading the headlines? What are some things we could be watching?
I really do think it is the consumer price index. That is the measurement stick of where the Fed's going to make their decision on interest rates. So I apologize, I don't know off the top of my head. I don't know if that's going to be next week or the following week where we're going to get that reading. But every month I would be paying attention to the CPI number, and they'll give some adjustments and understand what has it been over a 12-month rolling, what has it been from 1 month to the next. You'll also see it when things start to cool down a little bit. And probably the two biggest ticket items that I can think of are vehicles and houses, right? As if you see vehicles, I believe in the last couple of months, we hit an all-time high of the average car price in America. We hit the average or the highest average or monthly car payment in America. And so all these things are happening all at the same time. So when you start to hear home prices has settled down a little bit, car prices have come down, those are probably the biggest ticket items that we're going to see, because those are affected by the interest rates. The grocery store, as I said, we may not see grocery prices come back down. So if we're looking for something that gives us some insight that inflation is subsiding, I would say the big ticket items are the easiest way to know.
Okay, perfect. So, Sam, one of the things that I love to talk about when I'm doing buyer consults is I always I tell people I'm going to get them on the target first. I'm going to explain to them about what's going on in the market. And then I'm going to get to their specific persons and, what is driving things for them specifically. So talk to me a little bit about how you see inflation impacting your clients, your friends, your families, maybe even your investment decisions, those type of things.
Gotcha. I think in the personal life, once again, inflation affects everyone a little bit different. If you hadn't had to buy a house in the last 2 or 3 years, you're not going to feel the impact of the housing inflation, right? If you haven't had to buy a car. So everyone's going to be affected a little bit differently. But I always talk about kind of the different big sectors that are out there, housing being one, food, medical, clothing, and then travel. I know one of the big things that picked up over the last couple of years when we were stuck at home is people wanted to get the heck out of the house. And so they started to travel very quickly. Well, as you noticed, the airlines were trying to make up for all the time that they had very few people flying. And so that inflation of ticket prices had went very high, very quick. And they weren't flying as many airplanes. So we've all been packed into those flights a lot tighter and with those prices higher. So each person is going to feel those differently based on their lifestyle. But I go back to the grocery store of still being the one where we probably feel it the most. But I have certain clients that they haven't felt it as much because they haven't made those big ticket purchases that are out there. But as people are in different parts of their life, that inflation is going to affect them a little bit differently. And so that's one of probably the biggest things is you see someone that's retired, they're affected one way, where somebody younger that's starting their first job, they don't understand that their purchasing power has maybe dwindled because this is all they know. They're in their first job out of college or out of high school, and they don't know what inflation is yet.
Yeah, I love that. So obviously it can impact just your current lifestyle. But one of the bigger things that I'm hearing a lot of people asking, and I've actually heard this from several of my older clients, and then Sue and I have talked a lot about this with the reverse mortgages that we do. But a lot of people are asking us, how is inflation going to impact their retirement and their retirement planning? And honestly, there's a lot of fear there. So speak a little bit into that, if you would.
Gotcha. As we've seen in the last several years with inflation running high, the Fed responded by hiking those rates very aggressively, we said. And on retirees, it had a very adverse effect. You had both the stock portion, stock market down and the bond market down. So for people that are living off of their investments, they saved up over time, and now they're needing to draw down on their investments. Last year was a really tough year. Don't quote me, but I believe there's been 5 times in the history of the stock market where you've had both down at the same time. So that's going to have a disproportionate effect on retirees drawing down on their assets. Talking about purchasing power, you have a lot of Americans that are dependent on Social Security. So Social Security does that raise once a year to adjust the income that's coming in. And what the retirees experience on inflation are going to be, as I said, different from what you and I may experience out there. And that Social Security adjustment may not cover when healthcare increases by 10 or 15% from one year to the next that's out there. So the retirees, I would say, are probably one of the hardest hit people when inflation runs high like it is right now. And with that Social Security raise, as we call it, my clients that are retired, they'll always send me a little note going, "Hey, I'm excited. I got my extra 9%. It was one of the biggest increases, I believe, last year." And they'll go, "But I'm not going to see any more because my healthcare went up by more than that." And so they net lost purchasing power at the same time. So those higher cost of goods and services is going to have a smaller. Your money's just not going to go as far at the end of the day.
Yeah, that's a term we haven't heard so far today, but purchasing power is a really big deal. And if you're on a limited income and your cost of good go up, that means your purchasing power goes down, which means your standard of living is going to change, right?
Right. And we could see a lot of that over the coming years where prices outpace the average person. that can't afford a house. They can't afford their standard of living. And so we may see where, first time home buyers getting into a home, as you know, has become extremely difficult. And so it could change a lot of things if we don't get back into that equilibrium in the near future.
Yeah, it's one of those things, and Sue and I have been really touched by some of the families that we've helped with reverse mortgages. But it's amazing how they thought, hey, we've planned, we've saved, we own our house free and clear. We thought we had done it the right way, and now our costs are higher, and we're having to do a reverse mortgage because we just don't have enough money to live.
Yeah. Now I can't sit here and say that everyone needs a reverse mortgage. I'll give that disclosure that's out there. It's right for the right person. But I will share with you when it comes to reverse mortgages, personal opinion, non-Ameriprizes or anything I've done, but we've got in Texas, we've seen a lot of wealth being built inside of homes. I think a reverse mortgage is going to become more prevalent over time because I call it trapped wealth, trapped equity that I'm living in my house, but then I have this big, nice house that's out there with paid off sometimes, or maybe I still have a mortgage that's left, but I can't access it historically until I move out of that home.
Right.
But with the reverse mortgage, once we get past I spend a lot of time with clients when they get to a situation where they may need to tap into something like that they've heard all the negative things over the years of the bank's going to take my house or my kids and different things like that. But when you walk it through them and show the pros and the cons, there's always going to be pros and cons of that situation. It's providing for certain clients, the reverse mortgage, I believe is a good choice because they can get to this equity that they typically can't get to until they've sold the house. And so I can understand why you guys are probably having a lot more people ask about it in recent years.
So, and again, not putting you on the spot on this, but 10 years ago, 20 years ago, someone thinking about retirement, 10, 20 years from then, wasn't thinking about this type of inflation. So, as a financial advisor, how do you coach your clients to prepare for that? And how can we kind of be thinking, how do we prepare ourselves for this inevitable, or maybe it's not inevitable, but this inflation that is out there?
We really believe inflation will get back in check. You have, as I said, we had a long period of time when the inflation was running low, and then we have a period of time when it's running high. When we look back, there are good chances that it can get back into equilibrium. So I don't feel that inflation, and most economists don't believe that inflation is going to run rampant. So we do see that equilibrium. You're just ever going to, throughout the years in the US, you're going to see these periods of high inflation, some periods of deflation that's out there, and it's going to balance out over time. What I tell my clients, the biggest way that we prepare for that is it's why I do what I do with my clients. We go and update their financial plan every single year. And a financial plan, sometimes people just focus on the income they're making today and how much income they're going to need in retirement. My model and what I use with my clients is an expense-driven model. I want to know what it costs to be Tom and Sue to live their lives today and what that's going to look like in retirement. So as different items in their monthly expenses have gone up over time, then that's going to have an impact in retirement. I always say that financial planning is one very complicated math problem. If I know what it costs to be you on a monthly basis today, I can then inflate that out over time at a reasonable rate that we work with clients to choose. And then we can say, how much do we need to be saving on a monthly basis to build up an income stream to cover those expenses? And every person's different. I have some clients that are come in, like I said, that inflation hasn't had a big impact on their retirement, and other clients, we're going to have to retirement to be able to make a decision what that impact's going to be in their retirement, right? Is this their forever house? Is this their house and then they're going to downsize? And so I will share in most of my financial plans with clients, housing is one of the biggest factors when it comes to their retirement, because are they going to carry that mortgage into retirement? Are they going to use a reverse mortgage to stop that payment? Or are they going to sell and downsize? But redoing your financial plan every single year, doesn't have to be with me, but whoever you're working with, I would highly encourage you to spend time doing those expenses, because how can you build a plan if you don't know what you are spending today and the cost to be you? How are you going to plan for the future?
Yeah, I love that. That's a key deal. I had a client, I think you may know who this is, but they had a full plan for retirement. Everything looked great. As they got ready to retire, he went out and bought his dream car, which was a Ferrari, and he financed it. And then he was upset because his numbers that he had put in place to retire suddenly were blown out of the water because he had increased his cost right at the last minute, right?
Uh-huh. And I've clients that come in that they shock me, where they're wanting to move to be closer to family, and they hadn't brought it up in the previous 5-10 years. And they're moving to another state where they're going to increase the house price, increase the mortgage, and they get a little frustrated sometimes of, well, how's that affecting my retirement? And I'm like, you literally waited to the last minute to throw in this larger expense that has a major impact on your lifestyle. And I don't have too many people or anyone that has to go out and buy a Ferrari, but yes, that would, when you're buying a car that costs as much as a monthly house payment, I could absolutely see where that's going to screw up somebody's retirement plan.
So I want to hit on a topic real quick, and then we'll see if there's any other questions from the audience. But you had mentioned just a few minutes ago about the impact of low unemployment and how that was increasing inflation. And the obvious thought process, as you said that, in my mind is, does that mean we need to start seeing unemployment in order to reduce inflation? And I think that's one of those, I'd love you to kind of speak into that, because I think a lot of people are saying, well, we're going to keep unemployment, at 3.5% and bring inflation down. But until we start seeing some increase in unemployment, you're going to have an issue with inflation.
So let me throw another disclaimer on there. The economist, or who I always tell people, my job is to take complex topics and make them less complex, so we can have conversations and people can participate and understand. So when I've been talking tonight, I've been talking a lot of what the economists are telling us and I listen to a lot of different economists out there of what they say needs to happen, and go figure, there's differing opinions that are out there. I will share that when unemployment is low, you can have a recession, but if unemployment did start to work its way back up, it's going to help the Fed out some, because then with people without jobs, there's less money they have, so less money that they're going to spend, and that gets demand to come down. And so, yes, the Fed is never going to publicly say, hey, we'd love for unemployment. That's never going to fly. But understand that they know that could be an impact, and it would actually help inflation. I'm not saying it has to happen. And I think economists can say we can get these things back in equilibrium if consumers just pull back a little bit. But we're also worried, do consumers pull back very quickly and then we create the other side, then unemployment goes up. So it's very much, as I said, the Goldilocks scenario. It's just not too much, not too little. But yes, unemployment increasing could actually have impact on inflation to help bring it down a little bit faster.
Okay. All right. So before we take questions from the audience, give me the glass half full. What do you see in the next 12 to 18 months?
If you listen to most of the economists that are out there, they're happy that inflation has come down to that 3%. They know that the Fed has been saying this since they started raising the Fed rate last year, that they're going to wait until that inflation gets close to 2, or it's heading towards that 2% number that's out there. So the real question becomes, over the next 12 to 18 months, is how fast do we get down to that 2% so that the Fed can do what? The Fed can then start lowering rates. But the biggest thing I share with my clients is, don't expect the Fed to do this with rates. I know they were very quick on the upside, but they tend to raise interest rates quick and lower them at a more softer pace on the backside. So I'm telling my clients, be prepared that rates could stay higher on purchasing well into next year. And that's listening to what the Fed is telling us. The Fed actually tells us when they have their meetings like they did last week at Jackson Hole, they'll talk about what their thought process is over the short term, near term, and everyone's listening to the words that they're saying whenever they make those statements. And they're telling us we're going to keep rates higher until this happens, until inflation comes down. And the market had been ignoring them for a period of time, going, oh, surely they're not going to want to cause a recession. So they're going to turn around and lower rates faster. I think the people are now listening to the Fed and going, oh, wow, they're serious about this. They're not going to be too early on this because they worry about inflation going up. They'd rather hold them longer. Why would you cut rates if you get inflation down to where it needs to be and unemployment hasn't shot up? Why would all of a sudden they start cutting? And I think that's where people are not following the logic here, is that if rates are high, unemployment's low, and inflation's right, they're going to keep rates right where they are. They've hit that equilibrium part. So don't be quick, is what I would tell your clients, Tom. Don't be quick to go, oh, rates are going to come right back down. Yes, it can happen over time, but that could be well into 2025 for all we know. And I will tell you, there are estimates that assume that it will take some time. And then the question becomes, does it even go all the way back down to what we saw using your time frame of 2008 to now? Do we go all the way back to the 3% and 4% rate? Once again, they'll lower rates until they continue to keep that equilibrium. So they're not going to be fast to move it down and then cause inflation to go up. So I'm going to tell clients, be patient over the next 12 to 18 months to let this play out. And don't feel that we're going to go right back to the good old days of 3% mortgage rates or low credit card interest rates. It could take some time, what the new norm becomes.
Yeah. More slow and steady than anything else.
Absolutely.
Well, Sam, again, thanks so much. Sue, did you have some questions that came up?
We do have a couple questions, but I have a question. We were talking about rates not going down for a little while, and I was just thinking mentally, with houses not selling, all realtors being out of jobs, all lenders being out of jobs, wouldn't that kind of fix that unemployment numbers?
Yeah, seriously, when you see
think, right?
any one market that can get affected, and I look at that on unemployment, which is interesting. If you go back to the start of COVID, what industries were the most impacted? Where people like us, we could work from home or work from the office and not have clients come in. But what industry was affected massively in a very short period of time? Do y'all remember?
Travel?
Restaurants.
Travel. Yep, travel, lodging. Flights weren't flying. People weren't going to hotels. So that was one industry that was very impacted all at one time. What will be interesting is if we do see unemployment climb, what areas will be impacted? And what we're hearing, it may be more of a white collar unemployment, where the higher income people are affected and the lower income are maybe not affected as much, but also the blue collar workers that are out there building the houses and working in the restaurants that are out there, they're needed. And so, not that the white collar aren't, but they're needed. And so we could see a versus a sector type of unemployment affected, we could see a type of job or higher income affected more than lower income at this point in time, because of what Tom said, the labor force being tighter right now.
Well, one of the questions that came in had to do with student loans, believe it or not. Now that they will be coming due, how will that affect inflation at all?
Okay, let me give you both opinions on that I've seen from economists and analysts that are out there. I know Tom and I talked about this. I remember it like it was yesterday. He called last year when they were extending the student loan deferment, and he goes, Sam, you'll never guess what just happened. I had a client call me up, and go, hey, we want to buy a house. And Tom asked them to go, but you just said it was going to be too tight. They're like, hey, they're extending the student loan deferment. So we now have this extra, the 2 loan payments. I can't remember, Tom, if it was close to $800 or $1,000 a month. They're like, we're going to have that money. We can go and buy a house. That is kind of the definition of inflationary right there. Is, I'm not saying they should or shouldn't on student loans. I'm not going to get into that debate, but I'm going to say, oh, that allowed people to have more money in their cash flow, and they could go and spend on a house or spend on whatever they want. So this is it September or October when it's going to come back in. That's money that is no longer to be discretionary for those student loan payers. And so they're not going to have as much in their weekly budget, regardless where it is. That's just not, that money's now going back towards debt. So that is one way to get consumers to spend a little bit less on discretionary. So I would say that actually can help inflation. The other side of that argument is it's not a big enough number. So although there's a bunch, no one loves their student loan debt. If you take the totality of all the student loan debt out there and look at how much is spent, and I don't have the numbers off the top of my head, some economists will go, it's not a big enough number that it's going to have a huge impact, but it definitely could have some level of impact if people are very tight right now, paycheck to paycheck, and all of a sudden they have to pick up that could be the final thing that puts them to where they're underwater, and then credit card debt payments get missed and delinquencies start to go up. So it's going to be interesting to see how that plays out through the end of the year. But once again, is it a big enough portion of the economy will have an impact? We'll find out here through the end of the year.
That's good. That's good. Let me see here. Do you think there will be a good interest point going forward? Let's see. I'm sitting in cash in a good amount because I'm making more per month than with blue chips. I'm not sure what that means. The market continues to increase. Do you think there will be a good entrance point going forward? Will all this affect the stock market?
Gotcha. So I'll start with the last. Yes, absolutely. It's always going to affect the stock market with volatility. Uncertainty leads to more volatility, right? And so once we know the direction of the Fed and interest rates, the direction of inflation, the market will run with whatever that news is that's out there. People are piling up in cash a little bit more these days simply because of that uncertainty. And let's be honest, this is one of the first times in 10, 15 years that we can actually make some level of interest off of the cash that's out there. Because everyone's different, I can't tell you absolutely you're going to get an entry point to be able to go invest, but you need to match it up with your long-term investment plan. What I mean by that is a lot of clients are always looking for that perfect entry point, and then they are 2 years later and they've missed it. And we saw that after 2008, guys. After 2008, we saw this market dip, and they were so scared, some clients, that they were 3 or 4 years later, and they were like, they're waiting for it to go back down again before they got in. And then what happened? The market since that period of time has been on a nice steady rise until the last couple of years when we've seen some pullbacks. Is I would tell you, don't be too late. Do not try to time the market. Have a consistent plan of how you're going to dollar cost average in, because I'm telling you, I've seen it personally with my clients where they were so nervous and wanted to wait. They missed it. You're never going to time the bottom of the market perfectly. So I'm not saying an extra amount of cash may not be prudent at this period of time. I would just tell you to make sure not to be there. Don't sit in that situation too long and kick yourself if you're sitting late next year and things have improved, because the market's very emotional, very quick to react. And to share with you, the market will actually take off. If we did have a recession and the market reacted, understand the market will take off before a recession. We come out of a recession a lot of times. And that's because the market's forward looking. The market's anticipating what's going to happen 6, 8, 9 months down the road. So sometimes we could be entering a recession and the market's already going, this isn't going to be bad. And it could actually take off ahead of time. So that's why the timing aspect is so difficult that's out there. But I do have clients that have taken a little bit more conservative approach with cash that they've earned from bonuses of just hanging out with it for a little bit. But we have a strategy for each one of them of how we're going to dollar cost average back into the market over the next 6 to 9 months.
Okay, great. And our last question is, if you could come up with one phrase and or sentence that would be positive towards clients to help clients get through this time, what would that be? That's kind of a broad.
That's a great question.
But
let's see. I would go with patience. Is we always think it's worse than what it is. And what I mean by that is my clients today, it's like, oh, it's horrible. It's horrible. It's like, you have a job, you have savings in the bank, you're saving and doing what you can do. We can only control the things that we can control, right? We can't control the economy. We can't control our job necessarily unless we're self-employed. That's out there. And so I would tell clients to focus on what they can control and be patient and don't feel that they're missing out. I feel that a lot with clients is that they're missing out on this big opportunity to jump into the market or to make a bunch of money at once. I'm just sharing. I know it seems boring, but slow and steady will win the race over time. When you're planning for your future, you're not going to get it all in 1 year. It's going to take time. And the people that are patient are the ones that typically will do better over a longer period of time.
awesome. Awesome.
I want to throw in one thing because we didn't get a touch on this, Tom, and I know we chatted about it, and I'll be quick, but on housing here in Texas right now, I will share with you how some of my local clients, I get to work with clients actually all over the states and over the world, in fact. But I will share with you one of the things I am a little nervous about in Texas is the increase in home prices. Now, we just talked about where that can be a positive thing, but I believe there could be an impact because of the real estate taxes. And so what we're seeing in people's financial plans right now is that real estate tax bill is going up and up and up over the years as their house price goes up. Now, we do get the over 65 exemption in Texas if you qualify, where you get a little bit of reprieve. But my goodness, I've never wanted to turn 65 than anyone else to get that lock in on some of the real estate taxes. But for people's retirement plan, I do have a concern in Texas what that's going to mean if my real estate taxes can compound at 10% a year with these increases. So there's always a double-edged sword of, hey, we're getting this great appreciation on our houses, but our real estate taxes are coming up. It's actually becoming a larger expense in a lot of my clients' financial plans. So I did want to bring inflation down to a very specific here in Texas of what we're seeing and how real estate taxes. I'm interested to see how the Texas legislation handles that. I know there's some stuff out there that they're talking about of passing to be able to give a bigger homestead deduction that's out there. But I do think we have to do something to keep that ability for real estate taxes to jump at such a high pace, or it's going to be the cost of living, and for retirees, it's going to become more and more difficult in the state of Texas.
It's funny that you say that. I've got a couple reverse mortgages going on right now. And one of the things that they can do is called a LISA, which basically where we, as the mortgage company, we pay those insurance and those taxes for them. And I'm starting to see that more and more because they're afraid, you're right, of what's going to happen. So that's very interesting.
Definitely see that. Nope. Awesome.
Okay. Tom, you want to close us out?
Yeah, this has been incredible, Sam. So thank you so much for taking the time to do this on a Thursday night at 7 to 8 o'clock. So it was really awesome. And for those of you on the call and those who are listening after this, again, our whole goal is to continually bring value to the people we work with, to the clients that we've worked with for mortgages, and for obviously real estate transactions, and just make sure that we're the voice in the storm. So often, the headlines, and I was at an event the other day, and we were talking about headlines and how so often the headlines serve one purpose: to scare everybody to inaction. And when you really start breaking things down, Sam said it perfectly. Don't get afraid. Don't get anxious. It'll be a cycle. It'll be dealt with, and we'll be laughing about it here in the years to come. So thanks again so much for being on the call, Sam. So appreciate you, and Sue. Great job putting this together, and we'll talk to y'all soon.